It's Monday night, January 22nd, 2026, and I'm asking you for one simple thing. Pause whatever you're doing and focus for the next few minutes. While the internet is busy turning Greenland into a joke, something very real and very serious happened late Friday afternoon that quietly undercut the global silver market. This wasn't a rumor, it wasn't a viral clip, and it wasn't a speculative post. It was a document. A dry, technical government report that almost no one reads, except the people who actually shape markets. And if you own silver, stack silver, trade silver, or are simply trying to protect your savings in 2026, that document matters more than any headline you've seen all week. Before we go deeper, let me ask for a quick moment of support. The data shows that most people watching right now aren't subscribed, and that genuinely makes a difference. If you find value in this work, subscribe and drop OG John AG in the comments to show support and help push copycat channels out of this space. Now let's get into what the mainstream coverage is completely missing. On Friday at 4:47 p.m. Eastern, an updated mineral assessment was quietly uploaded to a U.S. government website, 89 pages long, packed with charts, tables, footnotes, and technical language that could put you to sleep by page 2. But buried deep in the middle was a single paragraph that changes the entire silver story. That paragraph describes a silver concentration in northern Greenland that is so large, so high grade, and so strategically positioned that it doesn't just influence silver prices. It challenges how silver is priced altogether. Before we unpack that, a quick reminder that the description includes bonus links, including the premium WhatsApp channel and the channel membership for those who want deeper updates and behind-the-scenes research. The revised survey focuses on a deposit in the far north of Greenland, close to the Arctic Circle, in a region most people associate only with ice, isolation, and military installations. The updated testing revealed silver concentrations that were not previously identified, and the numbers are not small. The estimate comes in at roughly 2 billion troy ounces of silver in a single deposit. Let that sink in. 2 billion ounces. Global silver production last year was somewhere in the range of 8 to 900 million ounces. That means one Arctic deposit, assuming it's real, developable, and controllable, represents roughly 2.5 years of total global mine supply sitting in one place. And not just any place, but a region at the center of an increasingly tense geopolitical struggle. Here's where things start to feel uncomfortable. The sampling window referenced in the report runs from last summer into early fall, roughly June through October. In other words, this assessment was effectively completed months ago, yet it wasn't made public until January 17th, the same week Washington increased pressure on Europe, the same week Greenland returned to the headlines, and the same week talk of tariffs and strategic territory intensified. Do you really believe that timing is a coincidence? I don't. And if you've followed this channel for any length of time, you know I don't throw that kind of claim around casually. I'm not suggesting every detail was orchestrated, but the pattern is far too clean to ignore. Now you might be thinking, why does this matter to the price of silver I see on my screen? Here's why. The price you see quoted on your phone is a paper price, a futures price discovered in a market where most contracts never result in actual metal changing hands. That system only functions as long as the world believes the paper price is close enough to the real price. Over the past few weeks, that belief has started to crack, and this Greenland development acts like a hammer on that fracture. Look at what's happening in the physical market right now. On Friday, futures closed in the low to mid $90 range per ounce. That's the number most apps will show you. But try to buy physical silver, and you'll quickly realize you're not paying that price. You're paying spot plus a premium, and those premiums are behaving abnormally. I spent hours checking dealer inventories, comparing listings, and speaking with people who move real metal. Government-minted coins are carrying heavy premiums. Maples, eagles, across the board, far above what you'd consider healthy. Even generic rounds are showing premiums that feel less like convenience fees and more like stress signals. When retail premiums stretch, that's the visible symptom. Underneath, the wholesale market begins to split. That's where things become dangerous for the paper price, because the real price, the one that actually clears physical supply, starts drifting away from the futures. Quote, I want to share something I can't prove with a neat public screenshot, but it comes from someone deeply involved in Arctic logistics, including supply routes through Canada, Alaska, and the Greenland corridor. He told me that physical silver quoted for delivery into certain Arctic nodes is being discussed at levels that look absurd if you only follow COMEX. He mentioned prices north of $130 per ounce, with one quote around $137. Let me translate what that means. If the screen price says $93 and someone is paying $137 for delivered physical silver in a specific region, you're looking at a premium of more than $40 per ounce. That's not a tight market. That's not temporary friction. That's the breakdown of a single global price. That's regional pricing, driven by access, security, and control. At that point, silver stops behaving like a commodity and starts acting like a strategic resource. And that shift changes everything about the next 6 to 12 months. This is where Greenland stops being a punchline. Most people think of Greenland as ice and empty land, but the Arctic is being revalued in real time. As shipping lanes open, as resource maps are updated, and as technological demand accelerates, nations are realizing that the next major choke points aren't only in the Middle East, they're in the Arctic. Silver isn't optional in this environment. It's essential for electronics, solar, electric vehicles, medical applications, and defense systems. So when a report points to 2 billion ounces in one place, that location becomes a prize. The details of the deposit matter. The report describes average grades in the hundreds of grams per ton. In mining terms, that's already significant. Push beyond that, and you're talking about exceptional material. They're describing a massive rock body, billions of tons in size, mineralized enough to push in-ground silver estimates into the billions of ounces. Pair that with companion metals like zinc, and the economics improve further. Silver rarely comes alone, and when it rides alongside strong base metals, projects become far more viable, especially when governments are willing to subsidize infrastructure. That brings us to the real battle. It's not just about extracting the metal. It's about who sets the rules, who finances the ports, who builds the runways, who supplies the power, who provides security, who controls export permissions. Control those levers, and you control output, whether mining starts next year or a decade from now. Markets don't wait 10 years to react. They move when the future changes. Zooming out, the silver market is already under strain. It has been running deficits for years, with demand exceeding supply and the gap filled by draining above-ground inventories. Vaults, ETFs, government stockpiles, private holdings, all of it has been drawn down. Every year the deficit continues. The margin for error shrinks. Industrial demand keeps rising. Solar panels need silver. EVs need silver. Grid upgrades need silver. Electronics and medical technology rely on silver. None of these sectors are slowing down. Meanwhile, mine supply isn't surging. Most silver is produced as a byproduct, meaning higher prices don't instantly translate into more supply. New projects take years, often a decade, to come online. Now drop a massive new deposit into the middle of a geopolitical showdown. That's when pricing becomes political. And when pricing becomes political, the paper market struggles to maintain authority. Behind closed doors, this is how the thinking likely goes. In Washington, a deposit like this isn't treated as a normal resource. It's leverage. Securing future access means protecting supply chains, supporting domestic industries, and reducing dependence on rivals. Beijing thinks the same way. If the U.S. secures Greenland, it gains leverage over global supply and pricing. If China secures it, the balance flips. If no one secures it outright, uncertainty itself becomes the driver, pushing both sides to hoard, stockpile, and bid prices higher. That's why I want you to think critically about where Greenland ultimately leans. Toward Washington, toward Beijing, or toward playing both sides for as long as possible. That single choice shapes the silver market for the next decade. Physical premiums tell the real story. A healthy market has boring premiums. When premiums expand moderately, demand is rising. When they expand aggressively while inventory's thin, the paper price is lagging reality. One price in New York, another in London, another in Shanghai, another in the Arctic isn't a unified market, it's a fractured one, where the official quote becomes a reference rather than a clearing price. Yes, government reports get revised. Not every deposit becomes a mine. Greenland is remote and expensive. All true. None of that negates the strategic impact. Control, not immediate production, is what matters. Even if development takes a decade, the holder of the rights shapes the future market. Logistics make this even more intense. A far north mine isn't just a pit in the ground. It's an industrial colony. Ports, runways, roads, power generation, housing, medical facilities, environmental systems, security. This only happens when someone writes an enormous check and has a strategic reason to do so. National security, not profit alone, is what accelerates projects like this. If this story breaks fully into the mainstream, the first moves won't come from retail investors. They'll come from governments and industrial buyers locking in supply. That tightens the wholesale market, pushes premiums higher, stretches delivery times, and makes paper silver feel increasingly unreliable. There are three broad paths forward. 1. Washington secures influence. Futures may sell the news on expectations of future supply, but physical tightness persists. 2. Beijing secures influence, calming domestic fears while the West scrambles. 3. No clear winner emerges, and uncertainty dominates. That third path, where Greenland delays and negotiates, is often the most bullish for volatility. The key takeaway is simple. The spot price is not your price. Your price is local, shaped by inventory, demand, delivery time, and perceived future scarcity. As this narrative develops, expect ridicule and reassurance in the media. Both are designed to keep confidence in paper markets intact, but confidence is fragile, and when it breaks, premiums become the truth. Watch what insiders do, not what headlines say. They're buying future control, funding infrastructure, and paying premiums in places no one films. Even the act of developing Greenland could transform it into a broader resource corridor, opening access to rare earths, uranium, and base metals, shifting global politics in the process. The next 30 days matter more than the next 10 years. Watch for statements from Denmark and Greenland, infrastructure proposals, sudden premium jumps, and inventory drawdowns. Watch for media tone shifts from mockery to strategic concern. Those are your tells. Silver is priced by confidence. Confidence that paper equals metal. Confidence that inventories are deliverable. Confidence that the world is one unified market. When that confidence cracks, charts lose authority, and real-world pricing takes over. Greenland isn't just ice, and silver isn't just shiny metal. It's a strategic input for the next decade of technology, energy, and defense. A giant deposit in a contested zone tests the entire pricing system.